Good afternoon, everyone. Good afternoon. Hope everyone's having a great day today. Good afternoon. Good afternoon. We're gonna give a couple minutes for people to get into the chat today, and we're gonna go ahead and get started once we get some people in here. So we're probably gonna give this a couple of minutes to let people kind of come in, and then we're gonna go ahead and get started. Hey, how are you, Miss Hammond? Nice to see you. Nice to see you. So I think that, we're going to have a very impactful discussion today. And I'm going to try to cover a lot of things in a very small amount of time. And so, I would ask people as they kind of begin to trickle in here if you have any questions, please use the question mark icon in the lower left-hand corner of your screen. Ask your questions there. I'm quite sure that we're going to have a lot of questions today, right? So please use the question mark icon in the lower left-hand corner, because with the amount of questions that I expect to come out of this discussion today, I'm not going to be able to just scroll through the chat icon and get back to you. So if I can just use the question mark button, it'll make it very easy for me. So help me help you guys. Okay, so as we've got people coming in now, I'm gonna go ahead and get started. So as you remember in the last discussion we had on credit last week, where I left off at was the difference between verification and validation. And I want to start there today, and I kind of want to get into this a little bit, right? Because, a lot of people, especially in our community, they want to have good credit. So, a lot of us don't have very good credit, and we want to have good credit. And so generally what we do is we go out to these self-styled credit repair gurus that say they can do all these great wonderful things, and some of them do okay, and others do not, and that's okay. But a lot of them don't have, most of them, I'd say probably 98% of them don't have any lending experience, and because of that, there's a number of things that they don't understand. And so, as we go through this series, my goal is to teach you how to do this for yourself. You really don't have to pay anyone to fix your credit, honestly. Like, you can fix and build and manage and maintain your own credit. In fact, you should, right? So my goal is to teach you how to do that, step by step by step by step, right? So today, where we're going to start off today is, I want to explain the difference between verification and validation of debt. And as I explain that, I'm going to give you the difference. I'm going to read you an example of something that I wrote for a friend of mine last year to help them with a situation that they had. And when it was presented, there was quiet discussion from the collection agency, and it was removed from the credit. Now, with that in mind, I want you to know that I'm going to share this with you, and as we get to that part, which will probably be next week, we probably won't get to this part next week about, how to do a validation. I'm more than likely going to make the letter available for everyone to be able to download from somewhere and use for yourself, right? So, I'm not only giving you knowledge, but I'm going to give you some tools and resources to help you be able to do this for yourself. Now, so what is the difference between verification and validation? Okay, so what tends to happen generally, and I'm going to speak for those who've hired credit repair agencies and, for the few that have tried to do this for themselves. Generally what happens is a verification happens when you dispute a transaction with the credit bureaus. And generally what you'll say is, I believe there could have potentially been some identity theft here. I don't remember this debt. And, so I would like you to look into this debt, to make sure that this debt is mine. So what you're really for is a verification, right? And so what the credit bureau is going to do is they're going to reach out to the collection company or the lender, whoever has the note at that point. And I'll get to understanding and explaining what a note is in a second. But generally they'll reach out to the current note holder, and they'll ask them, hey, listen, the name of this customer under this account number is disputing this debt. They're saying that it may not be theirs. Can you please verify the debt? All the lender has to do, or the collection company has to do, is respond to the credit bureau and say, yeah, we verified the debt. It's theirs. And then the credit bureau is going to come back to you and say, we reached out to the collection company or the lender, we verified the debt, and so the debt will remain as is, right? Now, this is where it gets interesting, right? Because then, it's like, what do I do from there? So generally what credit repair agencies will do then, or if you have a little knowledge on this, what you'll do is reach out directly to the collection company and you'll send them another letter. And what you'll do is generally the general rule of thumb is to send it certified mail, return receipt requested, right? And so you can count the 30-day clock that they have to respond. And generally what happens at that point is a credit repair agency, they send a letter to them, but really all they're doing is really sending another verification. See, because you really have to understand how to write a validation letter to make sure that, and cite it the right way and ask for the right things to force them to validate. So sometimes a credit repair agency will tell you that, okay, we're going to send out a letter to the credit bureau to validate or the collection company or lender to validate the debt. And that's great. Except for when they send the letter, they're actually not asking for a validation of debt. They tend to be very, very ambiguous with what they're writing. And so because of that, it's very broad, very general. All they get back is another verification, right? If the lender responds. A lot of times, credit collection company or credit repair companies, credit repair individuals, these gurus, a lot of them get really, really lucky in that the lender just doesn't respond, right? And so because the lender doesn't respond, it just comes off of the credit and they look really great, like they're really doing something. But in all actuality, if the lender responded, they probably wouldn't really know what to do. If the lender or a collection company responds, they probably wouldn't know what to do, right? So the wording between verification and validation is very important. So for example, right? So you have to understand that validation of a debt is covered under 15 USC 1692G subsection 809B, right? And, last week I gave you guys some homework to go read these rules and regulations and to get an understanding of what they say, right? These laws, because these laws govern how collections work, how reporting works, the Fair Credit Reporting Act, Fair Debt Collection Practices Act. They cover, how, these agencies are governed. And so it's very important that you understand that to hold them accountable to what they're supposed to be doing, right? So in light of that, right, when a credit repair company sends out this letter, they're really only asking again for another verification because they didn't understand how to write the validation properly. And so if the lender responds, they're usually going to respond with, we did our research, we looked at it, and we can confirm that X owes X amount of money on this. And based on that, we have confirmed that the debt is theirs, and there you go, right? And then generally, like, the credit repair agency will try to send another letter and another letter and another letter and another letter and another letter, and eventually hoping that the lender will just stop responding so it falls off, right? Not understanding that if you just simply ask for validation, right, and you asked for the right things in the validation, this would have gone differently. So I'm going to read to you what I wrote for a friend of mine last year to deal with this. And this is a validation of debt. This is how it works, right? I wrote, to whom it may concern. I am writing this letter in response to a debt collection account that is showing on my TransUnion Credit Bureau report. I have no recollection of this debt whatsoever. Therefore, in conformance to my rights under the Fair Debt Collection Practices Act, I am requesting you to provide me with a validation of debt under your organization's name that is showing on my TransUnion Credit Bureau report currently. Please note that your claim is disputed and validation is demanded effective immediately. 15 USC 1692G subsection 809B. Now, here's the important part. I do hereby request that your office provide me with complete documentation to verify that I owe the said debt and have any legal obligation to pay you. Please provide me with the following, and this is important. agreement with the creditor that authorizes you to collect on this alleged debt. The agreement bearing my signature stating that I have agreed to assume the debt. Proof that you positively verified my identity in accordance with your firm's Customer Identification Program and the U.S. Patriot Act's Bank Secrecy Act to confirm that I was the person who applied for this debt. Valid copies of the debt agreement stating the amount of the debt and interest charges. Proof that the statute of limitations has not expired. Complete payment history on this account, along with an accounting of all additional charges being assessed. Show me that you are licensed to collect in my state, and last, your license number and registered agent. If your office fails to reply to this debt validation letter within 30 days from the date of your receipt, all instances related to this account must immediately be deleted and completely removed from my credit file. Moreover, all future attempts to collect on the said debt must be ceased. Now, here's another important part. Your non-compliance with my request will also be construed as an absolute waiver of all claims to enforce the debt against me and your implied agreement to compensate me for court costs and attorney fees if I am forced to bring this matter before a judge. This is a validation letter. That is how a validation is done. And when you do it that way, right, 9 times out of 10, if it's a collection company, they are not going to respond. Here's why, right? You have to understand how it works from a lending and collection standpoint, right? So first of all, proof that you positively verified my identity in accordance with your firm's Customer Identification Program. Guess what? Most collection companies don't have customer identification programs. The lender, the original lender, was the one who conducted KYC and AML. And 9 times out of 10, and I can tell you this from experience, right? The lender, when they sold the note to the collection company, did not provide the CIP that verifies your identity. And because of that, the collection company will not be able to prove that they confirmed your identity, that they verified that you were the person who applied and assumed the debt. And just based on that, it will be very difficult for them to respond properly. And because of that, right, they will not respond. And because they do not respond, it has to go. That's how this works. It is very, very difficult if you write it the right way for a collection company to be able to properly respond to this situation. So let me explain to you how it works from a lender and collection agency standpoint. See, and this is where a lot of credit gurus fall down. If you've never been a lender before, if you've never sold a non-performing note to a collection agency, if you don't understand the difference between performing notes and non-performing notes, you are sorely lacking in the experience and education necessary to be able to go back to these collection companies and talk to them in an effective manner to be able to get done what you are trying to get done. Now, in light of that, right, let's talk about how these lenders work. So if it's a credit card, mortgage, auto loan, it doesn't really matter, right? What lenders are in the business of is lending. Their job is to lend money. They lend you money, right? And for that, they put a lien on whatever asset. If it is an unsecured loan, they looked at your FICO score and all of that. Part of the loan agreement was that you signed a straight note. What is a straight note? A straight note is the instrument that verifies the debt, right? This is the instrument. It is known on Wall Street as a security instrument. It's either an asset-backed security instrument or a unsecured security instrument. And it's very important to understand the value and importance of this instrument. In order for a lender, what lenders like to do is when they issue you a loan, you have to pay an interest rate. And as long as you keep paying the interest rate, the minimum interest rate that you can pay, whatever that's been negotiated to be, that note from a lender standpoint is considered performing. It is a performing asset on their balance sheet, and they can use those assets to borrow more money to lend. In order for that asset to be used for borrowing, it must be performing, which means you must still be paying interest. What happens when you stop paying interest? After a period of time of you not paying interest, that note now becomes a non-performing note on the lender's balance sheet. It is no longer an asset. It is now a liability. And because of it, what they do is they then sell the note to a collection company for whatever they can get. So sometimes if the note is really old and it hasn't performed for a long time, they may sell it for 10 cents on the dollar. They may sell it for 20 cents on the dollar. They may sell it for 30 cents on the dollar. What they're trying to do is recover as much cost as they can on that loan to be able to put that money back in. They'll write off the difference, right, against their capital gains to lower their effective tax rate, and they'll get rid of the liability and the headache. And now it belongs to the collection company. The collection company becomes a new owner of the debt. All the collection company is trying to do is make the difference between what they bought it for and whatever else they can get out of it. That's it. Now, what you must understand is when a note is non-performing, the lender doesn't care much about it anymore. So what they're generally not doing is keeping up with the records, keeping accurate records. They're not really keeping up with the file anymore because it has no value to them anymore. Their ultimate goal now is to just sell it to a collection company and let it be their headache. So a lot of times when a collection company buys a note, a non-performing note from a lender, they generally only get like half of the file. You see what I'm saying? So they don't have all of the documentation necessary to be able to properly enforce collection on the debt. But if you don't know how to ask the right questions, how to get them to provide the things that they are supposed to be providing, it is very difficult for you to be able to get this removed. And this is why we are having this discussion, because most credit gurus do not know how to ask these questions because they've never been a lender. So I wanted to explain how that part works because that part is very, very important. Now that we have an understanding of that, I want to segue into your credit report. I want to talk about the different things that are in your credit report, how it works, how it's weighted against your FICO score, etc., etc., etc. Now, majority of the information that I'm going to cover in this section is publicly available information. You can go directly to the source. You can go right to myfico.com and you can research this stuff for yourself, right? And you can read exactly what I'm going to share with you today, and you will see that what I'm telling you is exactly what it is. Now, so when we look at now mind you, I'm using the FICO score model 8, right, to talk about percentage weighting and things like that on your credit report, because that's the most commonly used FICO scoring model currently, right? So I'm using FICO score model 8. Things are weighted differently based on different FICO scoring models, which is something that I talked about in my last video. So I would encourage anyone to go back to the last video and understand what the different FICO scoring models are. Now, how different aspects of credit are weighted into your FICO score using the FICO score 8 model works like this, right? So payment history accounts for 35% of your FICO score. Payment history accounts for 35% of your FICO score. And what types of accounts are considered here? So let's talk about that, right? When we talk about payment history, the types of accounts they're considering are, for example, credit cards, Visa, MasterCard, American Express, Discover, etc. Retail accounts, that's credit from stores where you shop, like department stores, like department store credit cards, like let's say like Macy's or Target or somewhere like that. Installment loans, loans where you make regular payments, like car loans, like mortgages, right? These are considered installment loans. Finance company accounts, these are counted as part of your payment history. Mortgage loans, as I just told you, are counted as part of your payment history. Now, the other thing that they consider are public records and collection items, right? So what does that mean? Bankruptcies. Bankruptcies stay on your credit for 7 to 10 years, depending on the type of the bankruptcy that it is, right? Lawsuits. When you get a judgment, when you lose and a judgment is issued, that generally tends to appear on your credit report. And that is weighted against your payment history, which makes up 35% of your overall FICO score, right? Here's the other thing. Wage attachments, wage garnishments. So let's say that you have, you owe somebody some money, they were able to garnish your wages. They can report that to the credit bureaus, and that will appear on your credit under your payment history. It's a collection account. And at that point in time, again, 35% of your of your FICO score is dependent on payment history. So these things bring down your FICO score, right? Now, there are 7 components that make up your credit history or your payment history. And these are the 7 components, right? Payment information on credit cards, retail accounts, installment loans, mortgages, and other types of accounts. So the payment history there, that payment information is very, very important. The second factor is how overdue delinquent payments are today or may have become in the past. So if you've been late on things, you've got 30 days, 60 days, 90 days, that's all counted into the FICO score payment history under the FICO score 8 model, which makes up 35% of your credit score. Now, the amount of money still owed on delinquent accounts or collection items. So you may have had a line of $10,000 and you may have paid $5,000 of it before it went delinquent and went into collections, right? So that's a factor because you still owe $5,000 on it, right? The number of past due items on your credit report. How many past due items are currently on your credit report? How many charge-offs and collections do you have on your credit report? This all goes into your payment history. The amount of time that's passed since delinquencies, adverse public records, or collection items were introduced. So how long has it been since you were late? So of course, if you were late 5 years ago, it's a lot different than if you were late last month. So the amount of time that has passed, that plays a factor as well. And of course, the more time that passes from the last time you were late, the better it is for you, right? Because at the end of the day, what ends up happening here is as you prove positive payment history over a period of time from the last time you were late, right? Then what happens is, they stop weighting that so heavily. The 7th item is the number of accounts that are being paid as agreed, right? So based on the amount of delinquencies you have and the amount of credit collections you have, right, you may still have positive payment history somewhere. And so in light of that positive payment history, right, that is factored in as well. So your negatives and your positives are both factored into your overall credit score when we're talking about payment history. And again, payment history makes up 35% of your overall credit score. And that's very, very important to understand. Now, the next factor that's considered, right, is the amount owed on debt accounts. That makes up the amount of debt owed on your accounts makes up 30% of your score. Amount owed on debt accounts, 30% of your FICO score is weighted based on the amount of debt owed on your accounts. And there are 5 factors considered in this category. And these are the 5 factors. The amount owed on all accounts. Even if you pay off your credit cards in full each month, your credit report may not show a balance on those cards. And sometimes it may still show a balance on those cards. The total balance on your last statement is generally the amount that will show on your credit report. Very important to understand. Just because you paid it off, if you had a balance on the last report, right, on the last credit card statement, that's going to show up still, even though you just paid it off in the middle of the next month. It's not until your new accounting comes out that it will show that, right? So sometimes you'll notice that you'll look on your credit report and you'll be like, hey, I just paid this off. Why is it still showing a balance? Well, because they haven't had a chance to report based on the new circumstances and situations. Now, so that's one of the 5 factors. The second factor is the amount owed on different types of accounts. In addition to the overall amount you owe, your FICO score considers the amount you owe on specific types of accounts, such as credit cards and installment loans, right? So, and we'll get into this a little later when we talk about utilization rates and things like that. But a lot of, self-styled credit gurus will just tell you to keep all your credit accounts at the 30% utilization rate. And that may not necessarily work for your specific circumstances and situations, depending on how many open lines you have. So you have to understand the specific person's situation. There's no general catch-all situation for everyone. Every situation and circumstance is different, and you have to be able to weigh all the different factors based on each person's individual circumstances. Now, the next thing that plays into factor of the 5 factors here are how many accounts have balances. A larger number of accounts with amounts owed can indicate higher risk of overextension. See, when a lender is underwriting you for a loan, they consider your debt to income ratio, right? And there are 2 ways that they look at that. It's called a front end DTI and a back end DTI, right? So your front end DTI takes into account your so what they look at is your gross versus what's showing versus what the mortgage payment will be or credit card payment will be, and then they calculate a DTI. Your back end takes into account your net cash flow, right? What are you netting after taxes, right? So that's a different number altogether, right? So you have to understand front end and back end DTI. And we'll get into that when we talk about lending. At some point, we're going to get into a discussion of how lenders lend money and how lenders work. And we're going to talk about that, right? Now, but if you have, 30 different, credit lines open and all of them are at a 30% utilization ratio, and you only make let's say $4,000 a month. Well, if we calculate all the different 30% utilization ratios and if we calculate all the different payments for all those 30%, you might still be overextended and still not be able to qualify for the loan, even though it seems like you're managing your credit really, really, really well, right? So sometimes you can have too much credit, and too much credit's not a good thing either, right? So now, and this moves into the 5th factor, right, which is credit utilization on revolving accounts. Your credit utilization ratio on revolving accounts, the percentage of your available credit you're using, is an important factor in your FICO score. Using a high percentage of your available credit means you're close to maxing out your credit cards, which can have a negative impact on your FICO score. So if you're I'm sorry, sir, and if you can ask that question in the question mark box, but we'll get into that. Just ask the question in your FICO in the question box, please. But so how this really works is, right, if you have $1,000 credit line and you've got $800 or $900 on that credit line exhausted, well, you're at 90% utilization at that point. And when lenders look at your file, what scares them is the fact that it seems like you could potentially be surviving on your credit cards, which makes you a risk, right? So now, here's the other thing about that. Now, on the other hand, using a low percentage of your available credit can have a positive impact. In some cases, a low credit utilization ratio will have a more positive impact on your FICO score than not using any of your available credit at all, right? So sometimes, you know, you have credit cards open, but they have zero balances on them because you're not using them, right? But based on your situation, it might be better to actually be using a little bit of those credit cards. Not only that, right? You know, if you're not going to use the credit card, it's pointless to have it open because, and as we'll see, as we continue to move down this road, right? You know, a line, even if it's not being used or not, you know, counts against your overall credit ratio and the overall extension of credit that you have at that point in time. So that really plays a factor. And so if you're not going to use a credit card and you know you've got a lot of credit lines open, it might be, and you know I'm never going to use this credit card again, it may be, sometimes it's better to just close that line, right? It's better to just close the account altogether, right? But that's specific on everyone's situations and circumstances, and I'll be happy to give some examples along the way. But it is also important to note that your credit account balance isn't necessarily the balance that shows up on your credit report, as we discussed. Your account balance on your credit report will reflect the account balance your lender reported to the credit bureau, typically the balance from your last monthly statement. So even if you pay your credit card balance in full each month, your account balance won't necessarily show on your credit report as zero. And that's really important to understand as well. Now, the last factor that you need to understand in this is when we talk about the amount owed on debt accounts making up 30% of your credit score, the last factor that you have to consider is how much of the installment loan amount is still owed compared with the original loan amount. For example, if you borrowed $10,000 to buy a car and you paid back $2,000, you still owe with interest more than 80% of the original loan. Paying down installment loans is a good sign that you're able and willing to make and repay debt, right? Now, length of time on credit lines accounts for 15% of your FICO score. Length of time on credit lines accounts for 15% of your score. So what does that mean? There are 3 factors that are considered when they look at the length of time of your credit lines, right? And these are the 3 factors. Number 1, how long your credit accounts have been open, including the age of your oldest account, the age of your newest account, and the average age of all of your accounts, right? So all of that is weighted in. The second factor is how long specific credit accounts have been open. That plays a factor as well. And the third is how long it has been since the account has been used, right? So just because you have an open line here, if you're not using that line, again, that can weigh negatively against you. So you have to really be a good steward of how you're doing your lines and what lines you're leaving open, what lines you're not using, what your utilization ratios are. That all matters, okay? Now understand that these things that I'm telling you about, this is all available on your credit report for you to view, right? So if you just pull your own credit report, you can look at, the age of your credit accounts. You can look at, what your past due balances are. You can look at, how many times you've been late over the last year. You can look at all of these. All of these things are reflective on your credit report. Hell, you can, your credit report will tell you how many times you've been late over the life of the account. Like you just have to look at your credit report, but all of this information is available for you to view. This is not like some top secret information that only the lender has access to. No, if you just get your credit report, you can look at it for yourself. Now, so the next factor that goes into factoring, that factors into credit scores is your credit mix. And credit mix accounts for 10% of your score, right? So there are 2 things. So 2 things happen when you apply for multiple new lines at the same time. So some credit gurus, especially after they, helped you clean up some of your credit, they got some things. They go, go open some lines of credit and, go ahead and start establishing new credit. Open like 5 or 6 different lines, 7 different lines, 8 different lines, 10 different lines. Okay. Well, here's the thing about that, right? So 2 things happen when you apply for multiple new lines of credit at the same time. So, creditors check your credit, a hard inquiry, right? Which typically lowers your credit score and remains open on your credit report for 2 years. So every time you apply for a new line, that lender's pulling your credit. And when that lender's pulling your credit, you're getting a hard inquiry. Every time. Right? Mostly every time. I'll say mostly every time. You're going to get a hard inquiry. It's going to show up on your credit report. And inquiries do affect your credit. Not much, but they do affect your credit, right? But if you have a lot of hard inquiries, well, what does that tell a lender? That maybe you have a hard time getting credit. Or maybe you're just trying to get a whole bunch of credit in a lot of different places, and that's a concern for lenders, right? So now, FICO score, now what you have to understand about hard inquiries, and this is really important too, FICO score only considers inquiries made during the 12-month period prior to the time the score is last calculated. So your hard inquiries, they're only looking at back at the last 12 months, right? And now, here's the other thing. If creditors see you've opened an inordinate amount of new credit accounts within a small time frame, it could indicate to them that you're experiencing financial distress. Whether true or not, the result, a likely denial of the loan. See, that's the thing. When you open a whole bunch of lines of credit, like at the same time, just to try to, and you may just be trying to reestablish credit, build credit, do all of those things, increase your FICO score. All that's cool, great, and wonderful, right? But the reality of the situation is it looks risky to the bank. So you have to be prudent in your timing when you're opening new lines of credit. So that's very, very, very important. So what are the types of credit accounts? What different types of credit accounts do you have on a credit report? Let's talk about that, right? So what are the things they look at, right, when they're weighting you, right? What they want to see is, when they look at credit mix is what types of credit accounts do you have? Do you have experience with both revolving and installment loans, right? So what is the difference between a revolving and an installment loan, right? So a revolving loan, right, is a lot like a credit card. It is a credit card. Like credit cards, retail stores, gas station cards, even home equity lines of credit, right, are considered revolving accounts. And the reason why that is because you can pay them down and then, max them out again, pay them down, max them out again, pay them down, max them out again. You can do that, right? So you can pay it down and you can then go to the credit limit again. You can request a credit limit increase, and sometimes if you've got good payment history and you've managed the line very well, then the lender will give you and extend more credit to you onto that same credit card or that same home equity line of credit if you've got more equity, right? So it fluctuates. So the line fluctuates and that makes it revolving, right? What's an installment loan? An installment loan is something that you pay on every single month, but the amount of money that's been extended is fixed, like a mortgage, an auto loan, a student loan. It's fixed, right? So it's not like you can call and say, hey, just make a phone call and say, hey, increase my line, right? No, it doesn't work like that. If you have a mortgage loan and you want to, take out money in the house, you got to do a cash out refinance, right? So, or you got to establish a home equity line of credit. But you're going to go through a new underwriting process and all of those things, right? So that's the difference between revolving and installment loans, right? Now, so examples, and I just gave you some, of a revolving account is like credit cards, retail cards, gas stations, and HELOCs, right? Home equity lines of credit. Installment accounts are mortgages, auto loans, and student loans, right? So those are considered installment accounts. Now, and remember that, so that credit mix makes up 10% of your score. How the experience that you have with different types of credit, be it revolving and installment loans, right? That makes up 10% of your overall credit score. Now, new credit lines account for 10% of your score. New credit lines account for 10% of your score. Okay, 3 things that are factored when you're considering new credit lines are this. How many new accounts do you have? New accounts drop your average score account age, and that will have a larger effect on your FICO score if you don't have a lot of other credit information, right? So what happens here is if you don't have a lot of credit information on your credit profile, so let's say, right, you hired a self-styled credit repair guru and they were successfully able to get 90% of your collections off, and so now you don't have very much credit history on your FICO, on your credit profile, right? Then you go open like 10 new lines, right? So that's going to have an effect. That's going to have an overall negative effect. Yeah, once you start establishing payment history on those lines, that's cool. But you'll notice that it'll bring your FICO score down because you don't have much other credit history and you don't have much age on your credit history. So that weighs against you, right? So there's that. The next thing that's considered is how many recent inquiries do you have? FICO only considers inquiries from the most recent 12 months since the last score calculation. But again, how many recent inquiries do you have? How many places have you gone to try to open credit? That plays a factor. Now, there are 3 important facts about the credit inquiry that I want you to understand. There are 3 important facts. 3 important facts about the credit inquiry. Now, 3 important facts about inquiries are this. Inquiries usually have a small impact on the score. Inquiries usually have a small impact on the score. That's number 1. Number 2, many types of inquiries are ignored completely. And the score allows for rate shopping. So sometimes you might be in the market for a new car, right? And you might go to 3 or 4 different car dealerships because you're rate shopping. Provided that you actually acquire a car within 30 days, right? Those inquiries won't really count against you because the score, the FICO scoring model accounts for the fact that, you know, of course you're not going to go to the first dealership and take the first car potentially because you may not like the interest rate. You may think you can get a better rate at another dealership. So therefore you're going to go shop around a little bit, right? And the FICO score model, they do account for that. Now, when it says many types of inquiries are ignored completely, when I say that, there are differences. There are hard inquiries and soft inquiries, right? Hard inquiries, you know, generally if you're applying for a loan and you haven't closed a loan in 30 days, right, it's going to count negatively on your FICO score. But soft inquiries are just they're soft looks at your credit. And sometimes, you know, there are some lenders that only pull soft inquiries. You need to ask anybody that wants to run your credit. I don't care who they are. If you're running it for a background check, if you're running it for a job, if you're running it for anything, you need to know, are you pulling a hard inquiry or a soft inquiry? And if they tell you they're pulling a soft inquiry, you need to get that in writing. Because if you get it in writing and then it turns out that it's a hard inquiry, guess what? You can now have that removed because they said they would pull a soft inquiry and they didn't. They put a hard inquiry and now it's affecting your FICO score. They lied, and so therefore it can be removed, right? Now, when you talk about new credit lines, they also consider, so the FICO scoring model also considers how long has it been since you opened a new account, right? This is the age of your most recent opened account. Your FICO scores may consider the time that has passed since you opened a new credit account for specific types of accounts. This is a fact. And you need to understand that because that's very, very important. So again, spacing out your new credit lines or applying for new credit lines is a very, very, very important aspect of this that you should really be considering. Now, a lot of times, you know, and I hear this from a lot of people, they ask the question, you know, I just applied for a credit card, etc., etc. I've just applied for a car loan. I got the car loan. I got approved. I got the car, and now I'm driving around in the car, and I noticed that my FICO score went down. Why is that, right? Why did my FICO score go down, or why does it go down every time I apply for new credit? Well, let me give you the answer, right? So it's very simple. So when applying for new credit, an inquiry is placed on your credit report. That means, for instance, if you're trying to get a new credit card, the lender will inquire into your credit report for one or the 3 major credit agencies. Depending on the other factors in your report, this inquiry can lower your score by a few points. Now, how about this? A new credit card or line of credit will also affect your length of credit history. This part of your score is made up of your oldest accounts and the average of all your accounts. Opening new credit lowers the average age of your total accounts. This, in effect, lowers your length of credit history and subsequently your credit score, right? Now, also, new credit, once used, will increase the amount owed factor of your credit score. Amounts owed is composed of credit utilization, the ratio of your credit balance to your credit limits. Very often, the lower your credit utilization, how much credit you're using compared to your total credit limit, the higher your credit score. When you open and use new credit cards or lines of credit, you're getting closer to your credit card limit, which could mean a lower score. So opening new lines do have negative effects because they change the ratios, right? Because they change the ratios of, you know, the age of your accounts, your overall utilization on accounts, etc., etc. And so that's why it's not uncommon when you open a new account to see your FICO score change, because the model is now factoring in your new credit account against all of your already existing credit, and generally for a period of time that's going to weigh against you. But again, you'll notice, and a lot of people will tell you over 90 days to 6 months, they'll see a dramatic increase in their FICO score. That's because they've established a positive payment history on the new credit line. So now let's talk about how new credit lines can increase FICO scores. How does new credit increase FICO scores, right? If the new credit line or the new line of credit helps diversify the types of accounts you currently have, this can increase the credit mix. So if you've only had revolving accounts and you go out and get an installment loan now, right, this is changing your credit mix in a positive way. And because of that, right, that is going to be positive for your FICO score. So if the new line of credit helps diversify the types of accounts you currently have, this can increase the credit mix factor of your credit score. It shows lenders you can obtain and manage different kinds of credit, which can lower their risk of lending you money, right? Now, the other thing, let's say you open a new credit card account, which could initially lower your score, and then don't use the card for any new purchases. Over time, this can lower your credit utilization, which could mean an increase in your credit score. If you have bad payment history, right? So this is another way. If you have bad payment history and are starting from scratch to create a positive one, then opening new credit can help with that. If you can prove to lenders that you can pay your bills on time, this will help increase your score in the long run. So there are times where opening new lines of credit are very beneficial for you. But again, that depends on your specific situation, and nobody knows your specific situation better than you do. So if you understand these different things that make up credit, that weight your FICO score, and what goes into the weighting for each category, then you can better manage your own situation, because a self-styled credit guru may not know to ask all of these questions. Heck, they may not even know that all of this stuff exists. And because of that, right, they cannot design a program specific to your needs. A lot of these self-styled credit gurus, they're just doing a one-size-fits-all situation and hoping for the best. So it's like, if I throw a whole bunch of shit against the wall, right, some will stick. And that's dangerous for your personal credit situation. Now, let me tell you some things that you may not know, and that a lot of these self-styled credit gurus do not know, that is very important to understand. Establishing a home phone number, a home phone line, is very, very important for you. Very, very, very important. Because home phone lines tend, from a lender standpoint, when they see that you have a home phone number, not just a cell phone, what they see is that you've established roots. You've put roots down somewhere, right? So you're going to be there for the long term. And so because of that, that's very positive for them, because home phone lines, to a certain extent, equate to stability for a lender, right? So if you don't have a home phone line, even if you never use it, it doesn't matter. Pay the $10 or $15 a month and go ahead and get yourself a home phone line. It's very, very helpful for your credit report and for, underwriting where a lender's concerned. Because the fact of the matter is, if you're on the cusp, that home phone line could be the difference between you getting approved or you getting denied. It sounds really minimal. It sounds really crazy, but every little bit helps when you're trying to get credit. Like, especially if you're trying to do big things like buy a home or buy a really nice car and things like that. These are things that you need to consider. Now, the importance, I want to talk about aliases, right? So a lot of people, if you look at their credit reports, they have, they may be John Smith, John Hugh Smith, J.H. Smith, Smith John, John the Big Shot Smith, Smith John this. There's all these different ways that their name is laid out on their credit report, right? These are considered aliases. And the challenge with that is, if you have a whole bunch of different ways that your name is laid out, right? One of the things that the lender is concerned about is potential identity theft, or the potential that you will later on, if you run into some difficulty and challenges, that you will potentially try to use identity theft as the way to get out of making your payments and satisfying your debt obligations. So it's very important that you streamline and clean up, right, your aliases. It's very important that you do that. If you got a whole bunch of different ways that your name, you need 1 or 2 ways, and that's about it. Maximum 3. If you got like 10 different aliases on your your credit profile, you're wrong. You're wrong. And it's very easy to fix that. It's very, very, very easy to fix that. You can write to all 3 credit bureaus and let them know, hey, I noticed that my name is being showed on my credit profiles as this, and this. I want to let you know that my name is this legally. Here is a copy of my ID. Please update my credit profile records to reflect my name properly on my credit report. And they'll fix it. They have to, because they're reporting inaccurate information. And under the Fair Credit Reporting Act, for those of you who actually took the time to do the homework to go read it, you noted that the credit reporting bureaus must report timely, accurate information, period. So I wanted to cover these things. I'm going to stop here today, right? So I want to stop here today because I know there are a lot of questions. I see 11 questions in the box so far, and I'm sure as I begin to answer questions, there will be more. So I want to stop here today, and we'll pick this up again next week. But I'm going to open the floor now for questions. Please use the question mark icon in the bottom left-hand corner of the screen, and I will get to your question if time permits. So let's see. So the first question is, can we get this in writing? So I'm assuming you're talking about the lender, the validation letter that I was talking about. Yes, when I get to repairing credit and considering the different things that you do to go about repairing credit, there's a good likelihood that I'm going to put this letter somewhere in some sort of Dropbox or Google Drive and provide a link that for everyone to be able to access and download this letter for free to use for themselves once I've educated you on how to use it properly and what you need to be doing, right? So the answer to that question is yes. More than likely, it's very, very likely that I will release that letter to everyone free of charge. Thank you for your question, by the way. Okay, so next question. When opening a new credit line, after how long should one wait to make a large purchase? So again, that depends on your specific situation, your specific utilization rates, your specific age on your installment loans and revolving lines of credit. But generally, right, and it also depends on the size of the purchase in relation to your largest credit line at current, right, and the age of that. So, generally the standard rule of thumb is, if you've opened a new credit line, you want to try to give that credit line at least 6 months of seasoning before you try to go out and buy something large. You want to show the lender that at least you've got positive payment history on your new credit line. I mean, and sometimes it makes more sense to wait to upwards a year before you make a large purchase, right? So that again, these are general rules of thumbs, but again, the factors that I outlined when I initially started answering your question are specific to you, and so that a lot of that depends on your specific situation. But thank you for the question. Okay, so let's see. I heard that if you have a debt in collections, don't pay it, and the statute of limitations will expire. But if you pay something on it, it starts the statute of limitations all over again. That is actually an accurate statement. So anytime you make contact with a collection agency, anytime you begin to have discussions with them about potential settlement or anything like that, it gives them the opportunity to begin to re-report and reopen, and it restarts the time clock on you. That is absolutely correct, right? So thank you for that question, because I think that's a very important piece of information that people needed to understand. So next, can we get verification letter in a PDF format to download? I've already answered that question, so I think we'll go ahead and go to the next question. How to close the credit card? Do I call the company of the card? That's a great question. Yes, you call the lender and you tell them that you would like to close out your account. You establish the account with them, and so in the same fashion that you establish the account is the same fashion you're going to go about closing the account. You call them and tell them, I wish to close this line, or sometimes they may require you to put that in writing and sign it, or sometimes they'll send you some sort of account closure paperwork. But the first step is making contact with the lender, right? And then discussing with the lender what their process is for going out and closing that line. But yes, the short answer is absolutely go to your lender and make contact with them to go about closing your account. Thank you for the question. So let's see here. It's interesting how it's harder to get a loan from a bank, but easier to get from investors and faster. Well, I mean, I guess that depends, right? So generally, that's I would say that's a generally fair statement. But at the end of the day, right? What you have to understand is that, going to an investor or, such place as that, or a non-bank financial institution or a non-traditional financial type of lender is, the interest rates tend to be higher because they understand that you can't qualify with a traditional bank, which generally tends to offer better rates. So you pay a risk premium to go that way. So while it may be a little easier, it also may be a little bit more costly. And a lot of non-standard lenders, are a lot of them are asset based. So, they want to see some receivables. They want to see some sort of vehicle that has enough equity, a house that has enough equity. Like if you're trying to, get into a house for an investment piece of property, most non-standard lenders, like what they call hard money lenders, will only go 65, 70% LTV, which means you've got to bring in, potentially, 30%, 35%. And so, while it tends to be a little easier under certain circumstances, there are other additional criteria that play a factor into that. And of course, a higher rate, a risk premium. So, but thank you for that comment. So let's see what's next. Another question here. Give me a second, guys. I'm trying to open the question mark box again. And here we go. There it is. Okay. So now, can I do this for an old hospital bill, even if I have previously entered into a payment arrangement? So I guess the real question is, have you defaulted on the payment arrangement? And if yes, how long has it been since you've defaulted on the payment arrangement? And has that, account been, is it still sitting in collections at this point? I mean, have they charged it off, recharged it off again as a collection? If that is the case, then yeah, you can dispute that for sure. And we're going to talk about disputing and how to go about that and some of the words that you use to be able to do that properly. We're going to talk about that next week. Because in this game, it's not about what you say, it's about how you say it. It's not about what you do, it's about how you do it. And you got to be very selective with your word usage, right? Very, very, very selective and very, very, very careful, right? So we're going to talk about that next week. We're going to get into, the different criteria that you need to be considering when you're disputing, how to go about disputing, what the process is, what the step by step is to get, where you need to be. But yes, the answer to the question is yes, you could dispute that. Yes. So let's see. I have one collection account. Should I pay the total amount off or do I pay a settlement? So again, I'm going to talk about this next week, but depending on the collection account and how old it is, I would say neither. If the first of all, before you pay anything, make the collection company validate the debt. If they can't validate the debt, they can't collect on it. You don't have to pay something that, they can't collect on. They have to establish, the burden of proof is on them to establish that they have met the burden under the Fair Debt Collection Practices Act to be able to legally collect on that debt. And if they can't provide the documentation required under the Fair Debt Collection Practices Act to be able to successfully validate that debt in accordance with the Fair Debt Collection Practices Act, then they are not legally allowed to collect on that debt. So the fact of the matter is, you don't pay on a debt just to pay on a debt. Make them do some work first. Make them earn it. You want this money, you are going to earn it. And that's reality. So the only contact that you need to be making with them at this point, and we're going to talk about this next week, the only contact you need to be making at this point is for them to validate that debt. Because if they can't validate it, you don't have to pay it. That's fact. Thank you for the question. Okay, let's see. I have the last question here. How do the credit bureaus know your income? So generally, sometimes what happens is, your job, if you're receiving mail or anything like that, your job may sometimes, run a background check and then they'll have your job information. If you file taxes, sometimes they can pull that tax information right into your credit report. But oftentimes it's not even that. More along the lines of it's the lender that's going to know your credit because your your income because you've provided that information to them per request. So guys, that was the last question I had time for. I've got 12 seconds. So I want to say thank you for everyone for participating. Please like, subscribe, share, subscribe to my YouTube page. It's in my link or in my bio. Thank you so much, guys, and have a great day.